Hello, I'm David Cassidy with the market update today, Thursday, the 11th of June. Our focus yesterday evening, Wednesday, the 10th of June, was on the press conference from the Fed Chair, Jay Powell, for any hints on what the US Central Bank may do in the future following last Friday's, the 5th of June, stunning employment data when 2.5 million jobs were added. Jay Powell acknowledged some of the points we previously highlighted in these market updates, namely that Friday's 13.3% unemployment reading could be understated by several percentage points, and that the coronavirus lockdown has disproportionately hit the low paid and those that have jobs with a high risk of layoff, such as restaurants, hairdressers and retail. However, Jay Powell delivered everything we wanted when he said, quote, "We are not thinking about raising rates. We are not even thinking about raising rates." This was music to our ears, an absolutely perfect one-liner, as it clearly highlights that the Fed is going to keep US monetary policy very loose for the foreseeable future. In fact, he pledged to maintain the Fed's asset purchases at the present pace, which is $80 billion a month for treasuries and $40 billion a month for mortgage-backed bonds, and projected US interest rates will stay near to zero through 2022 as the preferred inflation measure, the core PCE, is likely to remain below the 2% target. Additionally, although he believes that the US economy will contract by 6.5% this year before rebounding 5% next year, he stated that these were uncertain times as the coronavirus outbreak has caused the biggest economic shock in living memory. Elsewhere, US CPI data yesterday showed both headline inflation and core inflation, which excludes volatile items such as food and energy, dropped to 0.1% in May, taking the inflation rates down to 0.1% and 1.2% respectively, the smallest core increase since March 2011. Now, as we indicated yesterday, after the Chinese PPI data, there is a growing risk of deflation. However, we would caveat that the coronavirus lockdowns are drastically changing consumption patterns, making the current actual shopping basket look very different from the weightings given to the various items in a normal shopping basket. For example, due to the lockdown restrictions, Americans aren't travelling as much, which resulted in airfares falling 4.9% and car insurance falling 8.9%, or having as many clothes, 2.9% fall, as they would normally, but they are buying more food for home consumption, which saw prices increase by 1%, and as a result, this all makes the reading slightly less representative of the prices American consumers are actually experiencing. However, looking at the individual elements, it still suggests to us that US inflation is running well below the Fed's 2% target, which provides us with additional confirmation that the Fed has to keep its monetary policy accommodating for the foreseeable future. While this is all good news for global equity markets, we've also previously warned that the path for financial markets will not be smooth, and we fully expect market volatility will remain elevated in the short term. And unfortunately, equity markets have fallen this morning as the focus has now turned to today's US weekly jobless claims data and the potential risks of a second wave of coronavirus cases after the US announced that infections had passed the 2 million mark. This morning, the FTSE 100 is trading down around 2.5%.